Hey, welcome to Bitcoin Math. My name is Shane. Thanks for joining me. Today we're going to look at MSTY and some of these other dividend producing ETFs. A lot of mania, a lot of excitement, a lot of fear, a lot of uncertainty around these things. And going back to some conversations I had with people back in May, I want to look at some charts and some numbers and some data to just kind of get a more objective sense of how these things work, not based on what everybody says and everybody's crystal ball about how this is going to be different and how this is going to be so exciting because MSTY is a unique thing, and actually just look at the yield max products, the other covered call ETFs, and just look at the trends, look at the data around those, and then model some of those things into our dividend versus Bitcoin calculator to get a sense of, what would have to be true about the dividend and the decay of one of these products in order for it to outperform Bitcoin, either through a HODL or a drip based strategy. So we'll get into that a little bit as well. But first and foremost, just to call out here, if you go to X and just type in MSTY, the amount of mania around this thing and what it can do and what it's going to do and why it's different and how it's going to produce income and all this stuff is crazy. You got shills, you got, girls out here talking about how it's the best thing since sliced bread and it's paying all the bills. I mean, there's literally no shortage of hype and speculation and mania around MSTY. A lot of people are jumping from MSTY over to MSTW now, and it hasn't even been a year of people really supporting the whole MSTY movement. I go back to some conversations I had with some guys online, just kind of asking the basic question like, well, what do you foresee MSTY doing over the next 5 years? Not really getting great responses. Nobody can predict what it's going to do. Gave me a range of, hey, if it can stay between $15 and $25 over the next 5 years, that would be tremendous. And yet now it's, at $13 or whatever it's at, and it's on a pretty rapid decline. And even then, I provided just some of the basic data, some of the charts, some of the models that I've created just to say, hey, would love any of your feedback on this, just on the different strategies, how MSTY and MSTY drip compare to Bitcoin HODL and even a Bitcoin drip scenario where you take your dividends from MSTY and you use them to buy Bitcoin. So, gonna model a couple of those things out. One thing though that I want to look at that I don't know if people are aware, but I mean, you can go to the Yield Max website and you can just go to their ETFs, covered calls. They've got a lot of these things, so there's a lot of data, right? There's no need to really speculate on what is going to be and what might be, possibly could be. We have data. So one thing that I found interesting is if you go to MSTY and you scroll down to the holdings and you actually look at the assets in the portfolio. Let me zoom in a little bit here. You look at the assets in the portfolio. MSTR call options make up 5.5% of their assets in this portfolio. Okay? 3.82, 1.73. The rest are T-bills and other treasury securities, cash equivalents, whatever. Now, I'm not saying that I understand how all of these things function, how all the mechanisms play together to generate the yields and what those yields look like, and how they're able to do that more as more people invest and buy MSTY. I have no clue. However, it is strange to me that a portfolio that is 95% T-bills and cash is somehow going to produce 100% annual divvy with only 5% of the portfolio being comprised of these call options where they're going to issue or you know, or call options where they're going to have this covered call strategy that generates triple digit returns. Again, I'm no options or derivatives or trader expert, so I don't know how all of this stuff works. It just seemed a little strange to me that such a small piece of this portfolio is what's supposedly going to produce these triple digit returns that people are expecting. Same thing with NVDY, right? It's the NVIDIA flavor of the covered call ETF. Same thing. You scroll down to their holdings, it's almost all T-bills. Government securities, T-bills, bonds, very little call options for NVIDIA stock. Same thing with Tesla, TSLY. Go down to their asset portfolio mix and you'll see the exact same thing. Lots of T-bills, right? A very small amount of this portfolio is made up of Tesla stock options. And so when you look at how this shows up on the chart, well, here's TSLY. Okay, that's the Tesla equivalent to MSTY. And if we go all the way back, we look at this info line here. This takes us back to July of 2023. So since July of 2023, TSLY is down almost 75%, from over $36 to about $9.50 now. Okay. And that trend line isn't looking like it's coming back. I could be wrong. Again, I'm no expert on this stuff, just looking at the data and how it exists. Same thing with NVDY, the NVIDIA equivalent to MSTY. Go back to June of 2024. If you bought the top, you're down almost 50%. All right. Now, sure, maybe you didn't. Maybe you bought this trough right here and you're only down 20%. But either way, the trends on these things do seem to be pretty similar, pretty patternistic. And if we look at MSTY, well, I guess it really depends on where you got in here, but if you were somebody who got in here, why does this thing never work? TradingView hates me. Let's go MSTY. Oh, okay, there's the line. So if you bought the peak there back in November of 2024, you are down almost 70%. Now, maybe you didn't buy that peak. Maybe you bought this trough here. You're down 26.5%. Or maybe you bought this trough here and you're down 18%. Either way, looking at the trends, it does kind of seem like the trend that we're seeing here for these yield max covered call ETFs is pretty similar across these three examples. So anyway, I found that interesting, and it certainly plays into how we will set up this model. So one of the calculators that we have here, dividends versus Bitcoin, we're actually going to model a scenario over a 5-year period that compares 4 different strategies. So let's go ahead and say we're going to invest $100,000, and our initial share price is going to be, we'll call it 20 bucks. Let's say our annual dividend is 50% and our annual decay is 20%. What do we think the Bitcoin CAGR is going to be for the next 5 years? I'm going to go ahead and say Sailor bull case, 37%. All right, so the chart here is going to reflect the 4 different scenarios. The purple, That's going to be a standard investment. So you're basically buying the equity. You're doing nothing with the dividends. You're just putting that cash in your pocket or into a checking account earning no interest. The red, the drip, that's going to be you took the dividends from the equity and you reinvested into more of the underlying equity. So in this case, if you bought MSTY and you were getting 50% divvies every year, well, you would be dumping those divvies back into more MSTY, and that would be your performance if the average dividend over the 5-year period were 50%, while the annual decay were 20%. Bitcoin HODL, straightforward. You took that 100K and you just bought Bitcoin and held it for 5 years, growing at 37% CAGR. And then Bitcoin drip means you actually bought the MSTY for 100K, but you took all your divvies and you invested them into Bitcoin. So in this particular scenario, with Bitcoin at 37, with your divvy at 50 and your decay at 20, the Bitcoin strategies are gonna play out more favorably over this 5-year period. But if Bitcoin only gives us Saylor bear case 21%, then the MSTY drip would outperform. The other thing to consider is, well, what if our divvy is actually more like 80? Well, now the MSTY drip is crushing everything else because that spread between the divvy and the decay is so much larger than the Bitcoin CAGR. Right? Now, if we ratchet the CAGR up, it will compete more, or it will compete more effectively, but it's still not going to compare to an 80% divvy that's getting reinvested every year to buy more that continues to produce 80 and then reinvest and compound over and over and over. But the real question here is, well, what can we expect from the decay? And that's where I go back to these charts, right? Because the decay here, if you bought right here, well, your 12-month decay is close to 70, right? That's 12 months. So what does this look like over the course of another 48? Nobody knows. Same thing with NVDY, right? Closing that one. Same thing with Tesla, though. We go back 2 years with TSLY, we're down over almost 75%. Right? So how does that decay percentage get annualized over a 5-year period so that you can actually make, a smart investment decision, or at least a more informed investment decision? And the answer is, I don't know. That's why I don't personally invest in these, just because the data and the trends on the existing ETFs is not great. And if MSTY is going to be different because MSTR stock is kind of a Bitcoin, got a Bitcoin nuclear reactor at its core, great. Then the MSTY bros are going to dunk on me online, and rightfully so. But those are kind of some of the things I'm thinking about. Now, let's say you're getting 80 on your divvy, but your annual decay is actually 40. How does this change things? All right, it changes things pretty dramatically, because now we've chopped that spread between the divvy and the decay down significantly. And so as you're reinvesting your dividends, well, that decay is eroding them pretty quickly. Whereas at 50% CAGR, your Bitcoin is basically crushing everything else. So, this model is set up to be dynamic. You can change all the inputs, and all of the outputs are going to update automatically. Right? There's lots of ways that these things could play out to be relatively similar over a 5-year period. And there's ways that could produce, significantly better returns for a a dividend producing ETF and an associated drip strategy. It really just depends on what you think is going to happen with the divvy and with the decay, and then of course what you think Bitcoin can do for that same 5-year period. Now, if you are looking for more of an income-based strategy where you actually get cash sent back to you so that you can live on that cash, yeah, a dividend-producing strategy where you get the cash to live, maybe that's a good way to go. Personally, if you had Bitcoin as the underlying asset, I'd borrow the dollars against that, figure out a way to finance it, get a balloon payment, get deferred interest. That way you can keep all the cash and don't have any out-of-pocket expense. And you can essentially borrow against the future value of the Bitcoin asset, and the loan can ultimately function as the income. Again, it's not financial advice. I'm not saying that you should do that. It's just another option that you could consider if you'd rather allocate to Bitcoin but still need to come up with some sort of an income than borrowing against the Bitcoin and having the loan principal function as your income. That could be another approach. If you like this video, would love to hear why in the comments. And if you're not subscribed to our channel, please do so. We want to try to release more content like this, and would love to get your feedback. What else you'd like to see, how we can make this stuff better. You can leave feedback here through the platform. I'll leave a link down in the comment section below. And with that, appreciate your support, and we'll see you on the next one.